So first and foremost, thank you all for joining. We've got a really wonderful discussion today, and it could not be better timed. So allow me to very quickly introduce myself. I'm Jason Druker from SFC Capital, the UK's most active early stage investment fund specializing in SEIS and EIS. And now, as many of us will know, the 5th of April is just around the corner. So SEIS and EIS are very much front of mind for many of us. Today, we're joined by Mary Tierney, Tax Director of Bennett Brooks, based in Northwich. Mary specializes in tax for owner-managed businesses and loves working with her clients because, in her own words, forgive me, Mary, for quoting you in front of yourself, they're people just like her with the same hopes and dreams, working hard to build something valuable. I think that sentiment is a wonderful place for us to start. Mary is joined by my colleague, Ed Pryor, the head of investor relations at SFC Capital. And Ed brings a very unique perspective, having made the leap from the political world, where he worked as an election strategist, a speechwriter, and a policy expert, particularly in venture capital and innovation. So couldn't really be more relevant. In his spare time, Ed enjoys discussing the merits of the EIS scheme as part of a balanced investment thesis with his 3-month-old son. And needless to say, the young lad sleeps very soundly through the night. I hope you don't snooze off as we go through the next hour or so. We're going to have some time at the end of this discussion to answer some questions, and the best way to ask them is to use the Q&A function in this Teams meeting. Please drop your questions in there and we will pick up as many as we can at the end. A reminder that today's webinar is being recorded and we are covering topics from a purely educational perspective. Nothing discussed should be considered as financial advice, and the products we will cover are of a high-risk nature and for professional investors only. Tax relief is subject to individual circumstances and is subject to change. The Seed Enterprise Investment Scheme, or SEIS, and the Enterprise Investment Scheme, or EIS, are government-backed initiatives that were introduced in SEIS's case in 2012, in the case of EIS in 1994, and they encourage investment in early-stage UK companies. They offer investors attractive tax reliefs, whether investing through an SEIS or EIS fund or directly into a qualifying company. And over the years, more than 55,000 UK investors have taken advantage of these schemes to support innovation and high-growth startups. Now, you didn't come here today to hear from me, so Mary, could you please kick things off by walking us through the key tax relief benefits?
Sure. Okay, well, let's look at the different taxes. So first, we've got the income tax relief, which is the relief most people enjoy and look for on the investment. So for SEIS, it's a relief of 50% of the investment. For EIS, for 30% of the investment, and it's given as a relief against tax payable. There are limits to the amount that an investor can put in. So SEIS, the limit any one investor can put in is 200k in any one tax year. Much higher for EIS, 1 million in a tax year, or if it's a knowledge intensive company, 2 million can go into a company in a tax year and have the. So if you were fortunate enough to have a tax bill of £1 million, you could put 2 million into a knowledge intensive company and get relief for the 4 million. So that's the income tax relief. Then we've got the capital gains tax reliefs. Again, they differ between the two schemes. The SEIS is the more generous relief over the long term in that it exempts 50% of a gain. So if you put 100,000 into SEIS and you've got 100,000 of a gain, 50,000 of that is just exempted. It's just wiped out, not chargeable to capital gains tax. That has to be in the same year that the income tax loss relief is claimed, because for both schemes you can claim the income tax loss relief in the year you make the investment or the prior year. The EIS CGT relief is different. It's a deferral. So for every pound that you put into the EIS shares, you can defer a gain, but that gain does come back into charge when either that EIS relief is withdrawn, if it is for any reason, or more likely on a disposal of those EIS shares. The only way that a gain deferred into EIS washes out is, and it's always good tax planning, dying. Dying's always good tax planning, not necessarily for other reasons. And then we have the capital gains tax exemption. And I think sometimes we forget about this until it actually matters. And when it matters, it's huge, because this exempts any gain on any investment made via SEIS or EIS from capital gains tax on a disposal. So if you're fortunate enough to have one of those companies that really flies and you exit, you won't pay any more tax on the disposal. But we do have to remember the other side as well, which Ed will touch on, I'm sure, where companies don't do as well and they may fail. It happens. And if that happens, then any loss made net of the income tax relief already gained. So under EIS, if you've put in £100, it's cost you 70 because you've had 30 back in tax relief, providing you had the tax to offset against it. EIS, you've put in 100, it's cost you 50. So that net loss, that can be relieved against income in the year of the loss, or again the prior year. And there is a general share loss relief for any shares in any unlisted company, but most share loss reliefs are restricted to well, the lower of 50,000 or a percentage of your income in a year. But a loss relief claimed under EIS or SEIS relief doesn't have that same 50k cap on the loss relief that can be claimed. So whilst it's a relief that's available more widely, it's more generous for EIS and SEIS. And finally, a holding in a EIS or an SEIS company will be generally a holding in certainly initially a holding in an unlisted company. And so, as we are at the moment, benefits from business property relief for inheritance tax, so it doesn't form part of your estate. We know that the business property relief is changing. And so for anybody who has more than £1 million worth of qualifying SEIS or EIS shares or other assets that qualify for business property relief or agricultural property relief, that will then have the effectively a 20% IHT charge, a 50% relief against IHT due. So things are changing, but we just don't have the detail of that yet, even though it's only just a year off. We have no consultation. Still, all we have is 1 or 2 sentences in the budget. So it's a little bit frustrating. So they're the various tax reliefs. Just a quick romp through them.
Thank you. I think we could do an entire hour on that IHT BPR impact, and maybe one day we will do that.
Yes.
Hopefully we won't, but
Yes.
one for another time. But very, very helpful to have the upside, the downside, the life of the investment all kind of packaged up there. So thank you for that, Mary. Can we go a step further now and, just metaphorically speaking, draw out an example of how the schemes confer their benefits for an investor?
Of course. So, and basically anyone who's got a tax bill will benefit from the tax reliefs that are available. But especially, so income tax, yes, but if you happen to have income tax and capital gains tax in this tax year or the prior tax year, then that has quite a substantial effect on your tax bill. So let's take an example of somebody who makes an investment of £40,000 and they've paid in, let's say this tax year, keep it simple. In this tax year, they've paid £20,000, or they are going to pay, either through their self-assessment or through pay as you earn, at least £20,000 of income tax. So they will either, they will get that 20,000 back. So they will either put the subscription on their tax return and not pay it if it's going to be a tax bill, or if they've paid it through pay as you earn or payments on account in another way. When submitting the tax return, they get the 20,000 back. So that's 40k investment less 20,000. If they've also made a capital gains tax in the year that's sufficient, they could also, that 20,000, then we've also got our capital gains tax relief on the 40,000 investment, the 40,000 investment. So assuming a 20% capital gains tax rate, there's all sorts of rates at the moment for different things, as you'll know, but again, 20% is nice and simple. I can do that. So that would give them a further reduction in their capital gains tax of 4,000. And so their cost of investment is reduced to £16,000. So they've got £40,000 worth of shares for £16,000. Right. Running to the future, suppose the company doesn't succeed, worst case scenario. So how much have they actually lost? Well, that net 20,000, so you remember they put 40,000 in and they got 20,000 back as income tax relief. That net 20,000 they can now set off against their other income in the year. And if we assume they're our top rate 45% taxpayer, and as we know, rates are being eroded, more and more people are getting poured into this top rate. I mean, the worst case would be there's that band where you pay at 60%, but let's assume they're a 45% taxpayer. So that net 20,000 loss, economic loss, you don't take off the capital gains relief. You've got that's kept. That 20,000 net of income tax relief loss they have, relieved at 45%. That's another 9,000 of relief. So the net cost, the net amount they've lost, if they get nothing back, the maximum loss in that scenario is £7,000. So 17.5% of the initial investment. I always loved the fact that when SEIS was first introduced, and Jason and Ed might be too young to remember this, I don't know. When SEIS was first introduced, when you got 100% capital gains tax relief on investment, you couldn't lose. If the company went bust, you were 6% better off. It was.
I was going to say, I remember that as being kind of described as the 103 days.
It was something like amazing. That? Yeah.
Was it 106? Yeah. Goodness me. So yeah. just lay out that calculation one more time. I've invested 40 grand. This is, by the way, all under SEIS. We're going to move to EIS in a second.
Yes.
But under SEIS, I've invested 40,000 into, just for ease, one company. I get half of that back as income tax relief. If I've got a capital gain to offset, let's say I do, I get some of that back as well. In your example, that was 40 minus 20 minus 4 equals 16 is the cost of investment post-relief. If it goes bump, right, so no upside whatsoever, the business fails, and these things happen, then I get further loss relief, meaning that actually my exposure or the net cost of my investment was only 7,000 off of receiving 40,000 of shares. That's a downside scenario, much aside from, well, what if the company actually does okay, good, great, exceptional? Then there's a CGT relief as well, but you don't pay CGT on the gain. So as we said, that's under SEIS. Ed, I'm coming to you next. Can you talk us through this slightly different approach that EIS takes, particularly when it comes to capital gains deferral, and how that can be used to keep on rolling tax liabilities? Assuming you don't die.
Yes. Well, actually, there's one anecdote I can tell you with that as well. EIS is different, as Mary explained very well. With EIS, you can defer 100% of a gain made elsewhere by reinvesting it into an EIS qualifying company. So in fact, although that tax doesn't go away, it is kicked down the road. And I was speaking to one financial advisor recently who was explaining that over a 20-year period, he kept rolling on EIS investment after EIS investment, and then took advantage of the inheritance tax relief that also came with the investment. So actually, the client never actually paid that tax, and then passed down the assets to their beneficiaries. So it is different. You're not removing all of the tax. You're just deferring 100% of it. Whereas with SEIS, you're obviously reinvesting that gain made elsewhere and taking a 50% reduction in your liabilities there. So it works a little bit differently.
Interesting. Okay. So if that gives us all a pretty sensible grounding, and a reminder, if you have any questions, we will do our best to cover them at the end. Please use the Q&A function in this meeting. Ed, what do we need to know about the ways that somebody can get involved in SEIS and EIS? We talk about these schemes, but how do I take the plunge should I wish to?
Sure. Well, there are two ways that an investor can get involved. It's either by investing directly into a single company, or it's by investing into an SEIS or an EIS fund, who will then build out a portfolio of companies for you. Now, just as an early stage investor, one piece of advice I always give is whichever approach you take, whether you're direct investing into a single company that qualifies for SEIS or EIS, or you're taking the fund approach, you should always adopt a portfolio approach to investing. That's because these companies are early stage, and so by their very nature, high risk, and you're going to have to accept a number of losses along the way. So you need to diversify that investment, take a portfolio approach to cover those losses. Now, this is often known as the power law in venture capital. The idea being that one investment can make up for a portfolio. What the returns from one investment can make up for losses in a portfolio, and that's why you often hear about investors talking about 10x returns or more when thinking about making an investment decision, because those that do succeed, you need them to really succeed in order to make up for these losses. So it's whatever you do choose, whether it's a kind of a fund or direct investing, just make sure you're adopting that portfolio approach when going about it.
Thanks, Ed. And I think something that I've heard a little bit recently is, succeed. What do we mean by succeed? And of course, this will vary investor to investor, your level of exposure, your level of diversification. And then, I've got to drop the U-bomb, if you will, which is that word unicorn, right? And so many people seem to get into investing, and I think this was sort of slightly a lockdown syndrome, seeking a unicorn or an outcome that was very much, let's say, outsized or an outlier. But in fact, and this will vary portfolio to portfolio and investor to investor, but in fact, oftentimes a stallion will come in sooner and will deliver returns that are more than sufficient to meet Ed's perception of the power law. So somewhere between a 5x or a 10x or a 15x return on an investment, just one can sometimes be more than enough to cover losses in a portfolio and then some. So, what's often said is if you wait around for a unicorn, you could be waiting for a very long time, or you're indeed your whole life. Whereas if you are seeking stallions, you often get to the end of the race a little quicker. So with that in mind, Ed, what's the type of profile that you think is kind of most suited to either somebody investing directly or somebody investing through a fund? And actually, maybe we should just talk about up front, what do we mean by a fund? What's in a fund?
Yes, so a fund is basically we pool a group of investors' money together, and then we, as the fund manager, will invest in a portfolio of companies, and all of these investors will receive corresponding shares for all of those companies. Now, that, I would say, is the best approach for 90% of people. I say that because really what's key to early stage investing is access to the best early stage talent, kind of knowledge of what to look for in a good deal, the sweat involved in managing those portfolio businesses afterwards. And so for most people that might be in banking or a trader or a lawyer or a doctor or an accountant, so on and so forth, actually they don't have time of day to do all of that. They're not necessarily well disposed to do that. So for most people, I would say fund investing works. If you are going to go down the direct investing route, great. That will require lots of time because you're going to have to look through a lot of decks to be able to find and spot the winner. You're going to have to build out lots of relationships across the country with the right networks that will get you the deal flow. And you're also going to have a bit more money, because most of the businesses that you want to be investing in will have at least a kind of a £10,000 minimum. And so if you're adopting a portfolio approach, which you should be, even as a direct investor, that suddenly is incurring quite a lot of money to build that portfolio. Whereas if you invested that 10,000 into a fund, that fund will build your portfolio with that same amount. So it really kind of depends on your access, your kind of skill at identifying the deals, and the time that you've got to dedicate. And if you don't feel that you're kind of best placed in all of those 3 points, it's probably better to be using a fund.
Thank you. So it's very interesting to talk about access, but also, it's sort of an attitude and aptitude thing, right? I need to want to, and I need to have the capability and time in order to do such a thing. What do you think investors should look for when they're investing in a company as opposed to a fund for the first time? And before you answer, a reminder to all of our audience and people listening, none of what we're talking about today is financial advice. You should always seek your own financial advice.
So we look at lots of different factors when evaluating a company. If I'm to try and boil that down into a few kind of key points, we're looking at level of innovation involved in the company. So what is it about this that isn't being done somewhere else? Are they fulfilling an acute market need? So is there real demand for what they're building here? Is the market large enough, or the potential market large enough to deliver outsized returns? And the market might not be there right now, but can we see a market in the future? A good example here is Steve Jobs with personal computers. There wasn't a market, but he had the vision to see a big potential market one day. And then obviously the team is really absolutely key when you're investing at the early stages. You can never be sure that an investment is going to be successful, but you can get a good idea of whether the company has a chance of being successful based on that early founding team.
Yeah, I think that really resonates with me. I know that I often say when I'm speaking to investors or on panels, we don't really invest in tech or in traction or market or a 10x opportunity. Really deep down, it's early stage investing. There's more qual than there is quant. It's about the team. It's about identifying co-founders as opposed to solo founders who know each other and have been through something together, who have a deep-seated passion that means that they won't give up when the going gets tough, and it will. And those things really, I think, resonate deeply when you're looking not just at a direct investment in a company, but also at a fund manager and how they think about investing early stage. And when I talk about early stage, we're thinking like entering under SEIS at the pre-seed round, or under EIS at the seed round or beyond to Series A and perhaps even past that. So let's shift gears. Let's get a bit more practical. Let's bring Mary back into this. Let's say I've just invested in a fund or a company. How do I actually go about claiming this tax relief?
Sure. Yeah, well, there's a bit of a process, and from an investor, they sit there and the certificates land, but obviously it's a bit like the swan's floating on top and underneath the legs are kicking, and that is the kicking bit. It's worth knowing what goes on before you get the certificate. So when a company's received its investment, it's then the company's responsibility to file, it's called a compliance statement with the Inland Revenue. And that's done as an online process. Generally, companies will have an advanced assurance, which is they've gone to the revenue before the investment. They've said, this is who we are. These are the shares we're expecting to issue. This is what we do. And the revenue say, yeah, that sounds like you're going to qualify on that basis. So if you've already been through the advanced assurance process, then the compliance statement is a much simpler process. If you haven't, you basically, if there's no advanced assurance, you have to tell the revenue everything that would have gone on an advanced assurance on the compliance statement. So that's filled in online, goes off to the revenue with a list of the investors and how much they've put in. The revenue then come back. The time they can come back can vary hugely. If you're looking, sort of August time, September time, it might come back in a few days. Very often it does. Over the next month, it's going to be slower coming back because the revenue will have a lot more compliance statements coming up to 31 January. It always slows down because suddenly a lot of people want their compliance statements issuing, because the companies don't have to do it straight away from the time limits. Obviously, they all should, because investors want to be able to claim their relief. But the companies have actually got a couple of years of a time limit to, not that we would ever encourage that, but strictly speaking, they can. So yeah, the revenue get the details on the compliance statement, and they send the company or the company's advisor, more normally, an email that says, we've got the compliance statement, here's your reference number, you can issue certificates. The certificates are then prepared. So where you've got a portfolio, you might have 50 investors. So you prepare 50 certificates. Wasn't that long ago, I remember colleagues of mine sitting around a kitchen table writing all these out. Time moves on. We have got mail merge now and we do them a lot quicker, but then we have a lot more to do as well. So the certificates are prepared. They're sent to the company signs them and sends them out to the investor. Now, that's then for the investor to then claim the relief, or pass to their advisor to claim the relief in the best way possible. And say relief can be claimed for that tax year or the prior tax year. Capital gains tax relief actually can cover a 4-year period for EIS. So there's some decisions to be made as to where the relief should be claimed, but the mechanism of making it is either as a standalone claim. There is a part of the compliance statement. Those of you who are familiar with it will know there's a part of the compliance statement you can fill out to make the claim. Or more normally, we see claims made on people's own tax returns. Quite a long period that individuals have got to make that claim, a 5-year from the filing date that the relief applies for. And it sounds like a long time, But if you think the relief can be carried back for 1 year, so if you make an investment now and claim for the 23-24 tax year, so last tax year, you've actually got till 2030 to make the claim. Occasionally you do see people who do miss that limit, although it sounds like a very long time. As with all revenue claims and elections, you get them in as soon as you can, because that's the best way to make sure you don't miss limits. But really, really, really important, the relief cannot be formally claimed either on the tax return or freestanding until you've got that certificate. It's totally wrong to claim it without the certificate, and the revenue will get very upset if you do. Now, there are circumstances in which you can benefit knowing you've got the relief coming. So, for example, if you pay tax through pay as you earn, the revenue issue a notice of coding, which determines how much tax they deduct from your salary every month. If you know, like any other relief, for example, if I know I'm making a pension contribution, I can contact the revenue and say, in this tax year, I've got this relief, so will you collect less from me? So you can do that if you know you've made a SEIS or SEIS investment and your tax liability is lower. You can say to the revenue, can you change my notice of coding? Or if you pay your tax payments on account in January and July, where you're estimating next year's liability, you can reduce your estimate. The revenue don't mind that, because if you get it wrong, they get the interest. And that's an understood procedure. So it's not, you can in certain circumstances accelerate the relief, but if you're claiming the relief through tax return or standalone, then you have to have the certificate. That covers everything.
Yeah, very well. But I might just add in, just to go back to my previous point discussing direct versus fund investing. This is also a way in which a fund can be quite helpful, because we have routes into the treasury because we're the most active SEIS and EIS investor. So we can slightly help to apply pressure to speed the process along, but also we do that with the companies too when we first make the investment. So we make sure that these companies get it organised as quickly as possible.
I can guarantee they're absolutely on it.
Yeah. So that's another consideration.
You took the words out of my mouth, Ed. Yeah, I think it is a really important thing to say about investing direct versus fund, SFC or otherwise. I think it's really important to say having a fund manager who's on your side, who has a staff of people who understand how these things work, has probably come across a lot of the kind of wrinkles and foibles that can possibly happen and has dealt with them previously, is a massive added benefit in my personal view. Mary, I'm going to take out my little violin and ask you what happens when it all goes wrong and when a company fails. I'd like you to tell us what the process for claiming loss relief is. And I think the important thing to mention here is that loss relief from an SEIS and EIS perspective is really just part of the game. And that for somebody looking at SEIS or EIS, potentially for the very first time or with us on the webinar today and has never heard of these things, that L word can sound quite daunting. But I think we need to recognize that actually, per our kind of sketch a few moments ago, that loss relief, if it should happen, is actually something of a safety net for a larger portion of your investment as well. Okay, so with that, Tracy, what's the process?
Sure. Well, the first thing is to actually establish when the loss arises. So, if a company's sold, if the shares are sold at a loss, that's a loss. It arises at that point in time. If a liquidator is appointed and the liquidator confirms to you as investor there is no return due, that crystallises the loss. That's an actual disposal. But you don't necessarily, and very often, don't have to wait for those points when you've made these sort of investments. So if you know, and it might be that the companies often tend to be very good over this, if they know they've got investors who have losses, they can be quite proactive in advising what's happening. So if the company confirms to you that it's going to fail, it's appointing a liquidator, or there are other ways in which maybe through SFC have been able to advise you that the company is failing and there's going to be no return, then you can actually claim with the revenue. It's called a negligible value claim. You say to the revenue, I've still got these shares, but they are of negligible value, basically no value. And that can crystallise a loss before the actual real loss on the liquidation or striking off or whatever of the company occurs. So that can be and is frequently, quite useful to claim the loss, because if you're going to claim a loss, generally you want to claim it the earliest time you can. So the first thing, you establish when your losses are arisen, either the actual disposal or you make the negligible loss claim. And that crystallises the actual loss, and you can then make the claim. Now, there are some time limits to make that claim. That claim can be set against income of the current year or the prior year. I'm not going to go into the detail of the time limits, probably a bit too much detail for today. But again, it can either be made on the tax return, and there are specific boxes and explanations to go on the return to make that loss relief claim for that year or the prior year, or as a freestanding claim. If you've already submitted your tax return, you don't want to wait for next year to put it on next year's return to carry back to this year, then you can write to the revenue as a freestanding claim. I can't guarantee how quickly the revenue will respond to that. As we all know, they're a bit of a nightmare at the moment, but it's probably more reliable to claim it on your tax return, but that's not to say you can't do it the other way and just chase them up on it. Sometimes they surprise you, sometimes they respond really quickly. They're a law unto themselves.
I guess in a similar fashion to our previous discussion on the last topic, again, it's where a fund manager can help come into their own, because
absolutely,
I'm sort of listening to that and I'm asking myself as a potential angel investor, okay, well, that's great, but how am I meant to know? What if these companies don't tell me that they're failing or have failed, right? I've effectively got to, keep looking at companies' houses or set up alerts. AI is obviously our friend in all of this. Whereas I think when you invest through a fund and have an active fund manager with a staff of people who look at this stuff and who push the investee companies, the portfolio companies, to report on a regular basis, and who have methods to track what's going on in that portfolio, your fund portfolio, then that can be incredibly value add as well, albeit it's adding value in a situation of loss or potential loss. So if you will, it's the silver lining on what is effectively not that bad of a cloud. Okay, so let me put away the sad loss relief violin and let's take out the happy gain trumpet. Let's put the gain in the upside in the spotlight. What happens when a company delivers returns to investors? We talked about stallions and unicorns. Well, who cares? Whatever they are, it's a gain. How does one go about reporting to HMRC, even if that, we talked about that gain being exempt?
Yeah, I think that's a really good question, because the problem with one of the many problems with our tax system is that we live in a world of self-assessment. And therefore, if the gain is exempt, then no, there is actually no reporting requirement to put it on your tax return. Having said that, if you are in the position of filing a tax return, and of course not everybody is, but if the revenue do accept a tax return from you and you have got an exempt gain, personally, I would put it in the white space. There are various places. If you've got other capital gains, you'll have a white space for the capital gains section. If you haven't, you'll have a general other information. And I would tend to put it on simply because we know, we don't know exactly how the revenue operate. We don't know when or how they decide to raise inquiries, but we understand that, they have certain triggers and they have certain links. And it's quite possible that they could have a trigger to say, so-and-so had a shareholding in this company, it sold, why haven't they put a gain on their return? So if you've put it in the white space to say, oh, by the way, because of course there will be other investors in that company who are paying capital gains. By the way, Mr. Inspector, I had this lovely gain, but I invested under EIS in this year, this amount, therefore it's exempt. And it just covers all bases. So yeah, my best advice would be put it on there, but no, you don't, strictly speaking, have to. But of course, always remember, if you rolled a prior investment into that gain, even though the gain on those shares is exempt, your rolled investment might come into charge. So always watch out for, you can get to where we do have some really quite complicated spreadsheets, as you can imagine, for some clients who make a number of investments, and some are rolled and some are carried back, and yeah, it all gets quite entertaining.
Especially when they've invested in funds that might have 10 or 15 companies per tranche.
Absolutely, yes, yeah.
You always got to have good advisors, right?
Yeah.
That's an interesting kind of thing you've said there about maybe over disclosing in situations of gain, and I think it might be that we come back to that theme in the Q&A, because Nicholas Cowley, thank you for your question. I think there's something in that there, so we'll come back to that. We've noted that. So this market we'd be talking about has 45,000 EIS investors and 10,000 SEIS investors. You are both working it day and night with clients who invest in these schemes. Is there some kind of commonality between these people, or is there kind of a useful indicator based on profile, job, background, anything like that, that helps explain the investor market makeup for SEIS and EIS? Maybe Mary first.
Yeah, I suspect maybe my knowledge of this might be a little narrower than Ed's, but what I see is they're entrepreneurs. Because I think it comes back to what you were saying, Jason. They're people who realise that sometimes you make losses, and it's the overall. It's playing the longer game. It's seeing the overall picture, which an entrepreneur will do. They're not for the little old lady who stresses over paying £50 of tax. So to me, it's our clients, and typically our clients who've built a successful business, lived through the ups and downs, realised that, and they're looking for their next bit of a venture. So.
Mm-hmm. Ed, what's your take?
Yeah, we probably have a slightly different perspective on the market as a fund manager. We definitely get a lot of those types, but really, I think broadly speaking, we've got kind of the high earner bracket and the kind of high net worth bracket, and within that, you get a kind of a whole cross section of professions, whether that's doctors, lawyers, bankers, brokers, entrepreneurs, and so on. Because of the rules, to qualify as a high net worth investor and be able to access these schemes, you've got to be earning over £100,000 a year. There are a couple of other bits in there, which maybe someone would ask about later. But really, it's a cross section. I remember a couple of years ago when energy prices were going left, right, and centre. We suddenly had an influx of people who had just been given a huge bonus, looking to offset the liabilities there. Otherwise, yeah, it can be a kind of a cross section of different professions, which is great. It makes our marketing a little bit more complicated because we're kind of reaching into a whole load of different buckets, but it's all good fun.
Interesting. I often think of it as if you look at the world as having winners and learners, then this is a space that might fit your personal ethos. So then with that in mind, what do you each actually do? Sorry to ask such a blunt question, for your respective clients/investors. Maybe Mary will come to you first.
Yes, question I often ask myself. So I touched on part of it before, and it's basically helping our clients who are making these sort of investments to get the most bang for their buck. So, it's not just about you're going to get a flat 30% of income tax relief, and it's about making the claims in the right year. You have to have the income to benefit from the claims. You have to pay the tax. SEIS is the CGT and the income tax. The way they relate to each other is different. SEIS, you have to make the income tax and the CGT claim in the same year, whereas SEIS, you can make them in different years. But with SEIS, because you've essentially got a 4-year period, there is going to be a different combination of claims to get the best outcome. And then there's the loss claim side of it as well. And it's, is it worth making a negligible value claim? Because if in that year you're not going to be able to use the loss relief, do you wait to have the actual disposal? Sometimes it's even explained, well, quite often, it's explained in the rules to the Inland Revenue. I remember one we had where the Revenue said, well, no, you can't have that loss. You can't have that loss claim because the company isn't of negligible value anymore. I said, well, no, it isn't, but it's actually gone bump. So it's a real disposal. Oh, yeah. So, it's sometimes telling the Revenue how it works. Then there's the other side, the bit more of the more proactive planning side. So a lot of our clients, they're only managed businesses. They can manage their income flow. They can decide whether, a process we typically go through this time of the year is what dividends should you be voting for this tax year? Not just about what tax rates are you in, but what reliefs have you got? What reliefs might you have? What income do we need to generate to utilise the reliefs you've got? So yeah, it can be quite, so we've got some pretty large spreadsheets tracking investments and reliefs, and like everything, it's about talking to your clients and finding out what is going on and what they want to achieve this year, next year, etc., to make sure you get the best outcome for them.
And then of course you overlay into it the fact that every year the rules and the rates change.
There is that as well. Yeah, absolutely. Yes. Yeah. Yeah.
Ed, how about you? Ed, what's your day-to-day like? Who are you advising, and how does it play out for you?
Well, I guess SFC, our mission is to try to invest in the most innovative, the most exciting, most high potential early stage companies. So we are obviously fund managers. So with our SEIS fund, we work with kind of leading universities, venture builders, accelerators, and so on to try and source these investments. And then we have our follow-on EIS fund that reinvests in the best performing companies from our whole portfolio. So it's a portfolio of around 500, just over 500 businesses now. And really then comes the portfolio management side. So how do we deliver the best possible investor experience? Because yes, ultimately outcomes are what people are going to judge us by in the end. However, there's a lot to do before that. And actually, how do we deliver a great experience for our investors? We obviously do that through managing the portfolio effectively through the portfolio management team, but also we have various features that we do to help deliver on that. We have to help deliver on that, such as our portal, which is a bespoke portal that we built, which basically helps our investors keep track of their portfolios as time goes on, whilst also keeping a kind of an arm's length approach, which is what we intentionally do at SFC, so that we don't put a lot of work onto their plates as the investor.
Brilliant. We're going to come to the Q&A very shortly, but before we do, maybe we have a few eagle-eyed or experienced people in our audience who might have been familiar with relatively kind of 2023 recent changes that were made to SEIS, allowing investors and startups to invest and receive, respectively, a little bit more. How did that change? Well, maybe let's talk about what it was, but then how has it sort of changed the makeup of the SEIS investor market, Ed?
Yeah, that's really interesting. So it was about 18 months ago now, I think, where the rules were changed, and basically it allowed investors to invest more each year. So going from £100,000 a year to £200,000 a year, it allowed companies to raise more, going from £150,000 in total to £250,000 in total, and that matched. Well, it goes a long way to matching the typical round size of a pre-seed round. It's not quite there, but it goes some way. And it also allowed more mature companies to raise under SEIS for the first time. So within 3 years of trading rather than 2 years of trading. And now that's a big change and changes the risk profile, because a 3-year-old business is a very different place to a 2-year-old business oftentimes. That has had a really interesting impact on the market overall. So we've had an introduction of kind of what I would term as kind of ultra high net worths coming into the market for the first time, often led by financial advisors. There's been a wave of different investor types coming in, and kind of interestingly, it came at a point where we were losing more of the smaller investors that were kind of tourist investors in that kind of post-COVID bubble, and they typically kind of were found on sites like Crowdcube and Cedars, investing smaller amounts. They left the market at the same time as this new demographic of investor came into the market. So I think, although the data isn't there yet, I think we're going to end up seeing potentially fewer investors, but more investment per investor. So the value of the market has increased, even if the volume of investors might decrease somewhat. So that's been a really kind of interesting knock-on effect, and hopefully will go some way to balancing out that 10,000 SEIS investors versus 45,000 EIS investors. Hopefully we're going to see a continuation of the trickle down coming to SEIS too.
So I guess say what you like about heads of lettuce and pork markets, but that was one thing Liz Truss probably got right, expanding SEIS.
Yeah. Yes, it was for us.
Good. So thank you both so much. We're now going to take some questions from our audience. We might not get to all of them. Maybe we will. Let's see how we get on. Let me just have a little skew here. In the meantime, take a breath. Okay, so we have one from, in fact, I'll avoid saying names because perhaps just for privacy purposes, better to just go to the questions. So we'll do our best to answer these. Some of them might be of a specific nature and thus perhaps better to be picked up afterwards, but let's have a go. So our first question is this: does investing in either of these schemes increase the chances markedly of the revenue, i.e. HMRC, triggering an investigation into your tax affairs purely due to the complexity rather than any presumption of avoidance or otherwise? Maybe that's one for Mary. I think that probably hits on what we were talking about a little bit earlier too.
Yeah, I mean, the honest answer is I have absolutely no idea, because none of us know what triggers an investigation from the revenue. And equally, we see personally in our firm, we see very, very, very few investigations. I don't think it would. I really don't think it would. It's a very accepted form of investment, as long as, I suppose the thing is you have to make sure the tax return is completed correctly. Now, it might be that if it's completed incorrectly, the revenue might just do an amendment. It might not necessarily invoke an investment, but you don't want anything that flags up anything that doesn't look right. But as long as you've filled all the boxes out correctly, my advice is always full disclosure. If in doubt on anything, full disclosure, not just because it stops the revenue asking questions, because sometimes it doesn't. They ask the question anyway because they don't read the return. But what it does is it shortens the period that the revenue can inquire into return, because the period is quite short. So if you look at a tax return for the tax year 23-24, that was due to be submitted by 31 January 25. Now the revenue have only got till 31 January next year to inquire into it, providing everything is fully disclosed. And if there's anything of any doubt, then you tell the revenue about it, because the chances are they won't ask the question, but it shortens their period to ask the question. Otherwise, they've got 4 years. But to answer my view, and I say I honestly don't know, my view would be no, it doesn't.
Thank you. The next question is quite specific to SFC and its SEIS track record and fund. So Ed, we might take this one ever so slightly offline, but if you'd like to have a go at maybe a sort of broader answer, just because we're going to try and keep this to an educational perspective, what's SFC's average exit duration for an SEIS investment?
Okay, we're keeping it broad. These are long-term investment horizons. Really, you're kind of looking at probably a 10-year period for a full maturity. That's not to say that you're going to wait that long to receive your exits. Our track record shows that about from year 4 onwards, we start delivering cash back to investors. But yeah, because they're early stage investments, you've got to be prepared for them, and also they're illiquid. So you've got to understand that this money is kind of shut away until.
Thank you, Ed. And just to mention that at the end of this discussion, or perhaps just before it, my colleague is going to add Mary and Ed's email addresses into the chat, so you can find them there and reach out if you've got other questions. So our next question is probably one I would sort of summarize as, here's a question for people that hit the snooze button too often every morning. So Mary, let's say I receive an SEIS certificate for a company. You've seen the question here. I'll just read it out for the recording. Let's say I receive a certificate for a company after investing, but I fail to claim that income tax relief with HMRC. Will I still be eligible to claim the other benefits like CGT or, in the worst case, loss relief?
So that's a really, really good question. And I must admit, this thought went through my mind when I was talking, and it was deciding whether I should throw it in or not. Two separate parts of that. First, the CGT relief. So the company goes well and you've got a CGT relief. If you haven't claimed income tax loss relief, then it is not tax-free on exit. Even a pound worth, you just have to have even just £1 of income tax relief claimed. And there is tax case law of somebody who didn't have any income, couldn't claim any income tax relief, and therefore didn't get the CGT exemption. So that's really, really important. The loss relief, that's slightly different, because do you remember I said before that for the loss relief, it's not only available for SEIS and EIS companies, it's available more widely anyway. So whilst you might be restricted by the 50k limit to the amount of loss relief you can claim, if you have subscribed for shares in an unlisted company, regardless of whether it was the SEIS or EIS relief, and that company fails, you can still claim. There are some other conditions, but they're quite obscure. You can still claim the income tax loss relief. So yeah, if it failed, you'd still get your relief. And if you are over the 50,000 limit, you still claim it. It just carries forward to future years from memory. But the CGT relief, the gain relief, no, you have to have had the income tax relief of at least £1 when you subscribed.
Okay, so if you're listening to us today and you're one of those people that hits snooze 5 times every morning, watch out. Get that tax return right. You sign the bottom of TR8, as I recall. Get it right. I think the advice earlier was, if in doubt, don't leave it out, disclose away and get that return in. Our next question is about certificates. Ed, probably coming to you on this one. Quite an SFC specific question, but why don't we ask you it this way? I'm an investor in a fund. What expectations should I have as to how long it would take for the fund manager to deliver my SEIS or EIS certificates, and why?
Sure. Well, as Mary talked about earlier, it can depend on time of year. As you head towards the end of the tax year, the Treasury just suffer from a lack of manpower, and so it takes them longer to get through all of the claims that they have. Really, we tell investors it can take up to 4 months. Sometimes it's a lot shorter than that, and again, it depends on time of year. We do have Ricardo, who will be in the who is very experienced at speeding up this process, both on the startup side and on the Treasury side, HMRC side. So I'd say, up to 4 months. But the key thing to remember is that the important date is when the investment was made into the companies, not when you receive your tax certificates.
Thanks, Ed. So the last question we have in the chat is, if I boil it down, what happens if a fund manager goes out of business? Quite a tricky one to answer, I think, today, not least because there would be implications with the FCA and step-in rights and things like that to go into. It has happened before, and I'm sure, although I hope it doesn't, but I'm sure it will happen again. But perhaps one that we would take offline or maybe direct to a fund manager. Ed, did you want to jump in?
Well, no, drop me. I can see it's Nicholas Cowley. Do drop me an email. It's probably not something we should talk about in an open sphere, but it's a question that people often ask. So drop me an email and let's get a chat about it.
Thanks, Ed. And thanks for your understanding to our question asker there as well. So that brings us to the end of today's session. Naturally, a huge thank you to Mary Tierney of Bennett Brooks and Ed Pryor of SFC Capital for sharing your insights, and to everyone who's been joining us and has joined us today. We hope that you found this discussion valuable as we approach the end of the tax year and SEIS and EIS are front of mind. If we didn't get to your question or you didn't get a chance to ask it, feel free to reach out. Everyone's details are now in the chat function. You can also find them on their respective websites. So Mary Tierney is at Bennett Brooks, 2 N's and 2 T's, and Ed Pryor is at SFC Capital. And a reminder that today's webinar has been recorded and we've covered topics from a purely educational perspective. Nothing we've discussed should be considered as financial advice, and these products are of a high-risk nature and for professional investors only. Tax relief is subject to individual circumstances and is subject to change. And so, in closing, a final thought. Whilst we cannot stop the clocks springing forward this March, we can make sure our tax planning ahead of the 5th of April does not fall behind. Thank you, everyone, for joining us.
Thank you.
Thank you.